over the past few months, this stupid, simple market structure strategy has made me over $2,000 per day. No fancy indicators, no guessing, no 10-hour screens. And after coaching over 7,000 traders, here's the ugly truth. Most traders don't fail because they're lazy. They fail because they're overwhelmed. Too many setups, too much noise, and no clean system. In this video, I'm gonna walk you through my 4-step strategy that I've used day in and day out to make millions in the stock market. Plus, I'll show you real trades, real strategy, and the exact checklist that my students are using to trade with confidence in the markets finally. Guys, the first thing to understand when you are thinking about trading is not patterns. So look, we've all read all these trading books and we're sitting there thinking, oh, let me draw this line, let me do this, let me get a flag, right? Let me get a flat top. And this is what trading is all about. That is so far from the truth. Those things are important, but they come at the back end. The biggest thing is to understand the big picture. What is happening on an overall basis, the all-encompassing bird's eye view of the market, and then you narrow it down into smaller time frames and small things like patterns. So market structure, guys, is everything. It is the whole ball game. When you are thinking about markets, market structure is the whole shebang. It's 90% of everything we do. From there, we want to be really thinking about the fundamentals and the price action. Now, when I say fundamentals, I'm not talking about like reading balance sheets and cash flow statements. What I'm saying is that we want to be always on the hunt for news. News. Guys, stocks that have PRs out and they have earnings out, right? So this is a PR earnings, press release or earnings. This is the holy grail of what makes stocks go, all right? When you think about like big explosive moves in the markets, they happen for one reason, news. So when you see a stock like a Palantir or something like that goes on a huge run from, $6, right, all the way to $130, that run wasn't just because we drew some squiggly lines on a chart. That run started because there was a piece of news out that guided this thing, that made it run. And so we want to always be on the hunt on the fundamentals, but on the news. And the key news source is earnings, right? Earnings is the whole shebang. It is the long-term driver of stocks. On a short-term basis, stocks move on technicals and market sentiment. On a long-term basis, stocks move on earnings. And then, of course, the price action. So once you have a piece of news out on a particular name or even the market, like for example, right now we're knee-deep in this tariff stuff, then you start to layer it into the price patterns and the price action, right? So you start at the big, and then you move into the little. But what too many people do is they start at the little, and then they're like, hey, let me go check the news, let me do this and that. And they're just so focused on their minute-by-minute action. And you see this a lot with, scalpers and futures traders. It's like just whatever's happening in that second is all they care about. But that's not what really moves markets, and that's not what's going to give you probability. And then, of course, you want to really think about your key support and resistance areas, right, where demand and flow comes into a stock and how those build key zones, right? What we're essentially looking for is lines in the sand, inflection points where, maybe there's a lid on the market or an individual stock. And when you finally overcome it, you get these explosive movements. And right, so we want to be mapping out those zones so that we can trade around it. How I tell my students from my 60-day bootcamp classes is we want to always be thinking about inflection points. If you can find the line in the sand on a particular name, that's an awesome stock to trade because you know the level that you want to trade around, where there's going to be an inflection point. Folks, when you couple all of this together and you combine it into a system, that's when you're really going to get some consistency in what you do. Don't follow candles. Pair the technical with real world context. When you understand the why behind the chart. Then you stop guessing. Now, it doesn't mean we're sitting there only trading on the why. We never do. But knowing that there is some fundamental catalyst, there's something pushing it, gives you an edge. Now, look, the key to timing your trades, once you have a certain target, right? So like during this season right now, earnings season, right? What I'm doing every single day is in the markets, I'm looking up stocks that have news out in the post-market and in the pre-market. And I'm looking for stocks with fresh news out. And then I'm sifting through, seeing what's interesting. After that, what I want to do is align stocks on multiple time frames. This is the key to really getting great entries. So often, if you have like a great 5-minute pattern, but your hourly doesn't coincide with what's happening on the 5-minute, and then the daily chart doesn't coincide with what's happening on the hourly, which coincides with what's happening on the 5-minute, then your trades end up being busted. When I grade my students' trades in our bootcamp class, I will see people leave notes and they'll say like, why? Like this pattern was just exactly what I learned in bootcamp class, and it was so perfect. Like, teacher, why didn't it work? And I always have to tell them, zoom out. When you zoom out and you see the whole picture, you'll notice that, yes, you had a nice spike on the 5-minute chart and you get a beautiful little consolidation. But on the daily chart, maybe you were in a big downtrend. And on the hourly chart, maybe you're just in a chop zone. And so what happens is you get like a nice little momentum on the 5-minute chart. But on your big picture, the chart is telling you that the stock is actually a short. And so that strength you see, instead of buying it this way, you need to actually be fading it, because that's what's happening on these different time frames. And so we always want to do a top-down approach. The bigger picture time frames give us the idea. They are for idea generation. And then our intraday time frames are used specifically for execution and managing our risk when we're day trading. And that's like a huge portion of what we do. So like if you think about, I'll walk you through a trade that we've been messing with in our chat room. So in our chat room, I trade live on Zoom in front of everybody, all day. So I trade on Zoom in front of my members all day, and I alert everything I do. But one of the things that we did, like 6 minutes after the market on a couple days ago, I alerted to everybody that we were going to be buying HIMS, and that we were trading it back and forth all the way to the end of the day, where I was solding my last few thousand shares in the 49s. But what I essentially did was I knew this stock had earnings out, right? And so I put it on the watch list because it has earnings out. What I'm doing is looking at the big picture here, right? And so if you look at the big picture here, I look at this HIMS and I'm like, okay, we've got ourselves a nice trend here and we're clearing out this base, right? And so the earnings came out. But in the pre-market, the stock was actually down and it gapped down about 3 points. So 3 points on what, $40, right? About 7-8%. It gapped down and everybody in my chat room was saying, oh my gosh, like the news must have been bad. It's gapping down. But one of the things I was pointing to them is, look, when you are aligning stocks on multiple time frames, right, look at the hourly chart too. It's going to give us a little bit of a clue. So when I went and shifted to the hourly chart, one of the things that I noticed when the stock started to open was that it retested this big breakout bar here. So see this gap here? HIMS had a piece of news out with NVO, Novartis, which is one of the biggest European drug makers, and they're going to be doing some type of deal with HIMS. And the particulars of it doesn't matter to me, just the fact that there's news. And so that particular day, the stock went from 28 to 38, and it topped out there. But this is a huge, huge level now, right? Because that was the level from the day the stock had news out. And so what ended up happening is, as the earnings came out, and on the hourly chart, like I'm watching this thing in the pre-market, on the hourly chart, it's testing right into that sweet spot, guys. right into that sweet spot. So what do we want to do, right? I want to come in and think, okay, I like the daily chart. This is my hourly chart, and you can see you got a beautiful trend on this thing, right? And I'm coming down into this support area here. To me, this is a no-brainer, right? So as the stock comes down into the support on the hourly chart, I don't just long it because I like to get a little bit of confirmation. But as you started to go red to green, that's a simple trigger where you're negative on the day and now you're positive. You can add a position right there. I waited till we actually got over the previous day's high, because when you know all the levels, previous day low, previous day's high, when you clear over the previous day high, stocks will tend to move very fast, as now you're clearing these intermediate term levels. And so I alert this thing right here, put my stop under the moving averages, and now you're off to the races, right? Now look, this is the thing with pieces of news. Okay, so you have a piece of news out. Does that mean you're just going to take this one trade and you hold it? No. As short-term traders, we can swing trade these things if they consolidate on a larger term time frame. But as day traders, we want to take 2 to 3 to maybe even 4 stabs at the stock, because we may get ourselves in a trender. Look at the chart for TEM today and yesterday, right? Similar action. We were just marauding this thing in the chat room the last few days. So as this stock starts to pull back into the moving averages, I find that the first, right, pullback is always really, really effective. And so now you get, right, these like subsequent, moves. And so this is a huge portion of trading. We've got to always think big picture, then we move down into the little picture. So how do we get all this going? So number one, you got to filter out all the noise, right? So I go through and I want to make a list of names, 4 to 6 tickers max. So one of the things I'll do is I'll check out which sectors are moving strongly. That's a big portion of top-down analysis. So I use a layout here. All my students have access to it, where I watch all the different market indexes. And what I do is actually do a 5-day sort, and I'll start to see what type of sectors are hot. So you can start to see here, like this is IBIT, so Bitcoin is heating up, right? You have SMH, so on and so forth. So I'll flip through all these indexes to map out what type of sectors are hot. Then I will narrow things down from going inside that sector and seeing the individual stocks. Beyond that, right, I want to go through and look for the gappers in the morning and start to really filter out like what type of stocks are having news out. For example, top of our watch list today was this QBTS. QBTS had news out, shares rise after reporting narrowed net loss, higher revenues, blah, 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 right? And if you look at its daily chart, right, you got a really, really nice setup forming on this bad boy. So this is the perfect type of stock to put in. You have a stock with a big base. You can see even in the pre-market, it was doing tons of volume. It ended up with 200 million shares by the end of the day. Guys, this thing moved up 50% almost. And look how clean it is. So the thing is, when you have stocks with news, like if it's a pump and dump stock from a stock like somebody alerts in Discord, they'll just pop and fail. They won't be clean. When you have true order flow, right, because of news, the stock is going to move a lot more clean. It's going to move linear. You're going to have less shakeouts and a lot more certainty to your trades. And so I like to go through the indexes. I'll go through the gappers. And then I have a whole host of different scans that, I like to run. And we'll start to narrow these things down piece by piece, right? As I'm starting to go through this, I also like to see, right, are there stocks that are actually making significant moves, or are there just like a lot of stocks in the previous days that are just making small moves? What I mean by that is I like to track 4% breakouts. Why instead of 4% breakouts, instead of say advance versus declines, right? Or like how many stocks are moving up versus down. I like to do 4% breakouts because I'm looking for significant movers, right? I know that a healthy market is a market that has speculation. So we need stocks that are making significant moves, not just like, hey, I'm up 1 penny, down 1 penny. That would show up on the advanced versus decliners, but that's not the type of stuff that we're interested in, right? We're interested in significant movement. Then we always want to be checking, right? Is the volume expanding, right? So it doesn't matter, like, okay, in absolute terms, hey, this stock did 4 million, 5 million, 6 million. What we're looking for, right, is the expansion of volume. So you can see, like today, it did 10, 20 times more, right, than it's normal. So the volume is expanding. That's what I'm interested in, right? When you see a stock, right, like a HIMSS that takes off, you can see here, normally it's doing 20, 30 million shares, and then boom, it does 150. Boom, it does 160, right? That's an expansion in volume. What that's telling you, volume, you don't buy because of volume. But what volume measures is the emotional intensity of traders. It tells you how bad people want it. And that's where we want to start to filter through. It's going to remove a lot of the noise from what you're trying to do. So remember, volume is a confirming indicator. It comes in post a move. So you don't buy because of volume. If you saw a bunch of volume in a stock and you bought it, it means you're the last man to the gangbang. Like the move already went, right? If there was already all the volume in the world and then you're buying it, it means you're the last one to the party. Volume comes in post move. So like it assigns meaning to a move, but it doesn't come before the move. It comes after a breakout. Then you want the volume to really, really increase, right? And what that does is it adds validity, it adds confirmation, it assigns meaning to the move. And that's where we want to really think about volume. Don't worry if a stock has a lot of volume before you buy it. The volume needs to come out after you buy it. Now, look, you've got to make sure that you confirm your bias, right? So you're thinking long, you're thinking short, right? Start mapping it out. Are we opening above, below yesterday's levels on the stock? How are you reacting around the pre-marked resistance, right? So when we look at something like, right, this HIMSS, right, I'm mapping out everything. Like, where are my spots? How is the stock reacting there? Does it hold? Okay, if it does, I'm going to move to a smaller term time frame and come in hot on the trade with a little bit of canal de side gusto. From there, I want to look for entry. So I got a handful that I do. So I teach all different types of patterns, swing trading, day trading, futures trading. There's so many different things out there. But if you can just narrow down into a handful of these specific things, you can use them in all different markets, whether you're options trading, stock trading, futures trading, you'll have these type of things. So number one, you have just a quick pullback entry. This is the first pullback, right? So like after you get a big pop, you're going to have a fizzle out that'll suck in some shorts. People will be like, oh man, maybe this thing is done. And then you'll get a candle to hold and then it'll be off to the races. So when you see something like that, I love this type of setup. So if you're looking at, like, for example, this HIMSS, right? You get the big pop. You start to pull back into the EMAs. You want to see where it holds, right? When it starts to hold somewhere, good. You get a green candle to hold. Now you want to be purchasing this, and you can put a stop under the low. And I don't wait for the candle to close. Like as it's forming, right, I want to be into it. I just use a stop because then you're going to get a little bit of a better entry. And now you're into this thing, right, for the bounce. Guys, I do this setup. I mean, this is like my go-to, like even today, right? Like we did it right in this TEM. It was amazing. Like you could see here, right? You get a pop in the morning and then a nice easy pullback into the EMAs. When you get the green candle to hold, boom, you're off to the races. And then, right, you get another pullback to the EMAs, boom, you're off to the races. That's my bread and butter. That's something you guys can utilize right now. Whether you're a new trader, old trader, don't matter. That's a go-to setup that's standing the test of time. Now, the secondary plays, right? You can have flag breakouts. This is when you're getting a trending name and then you get a slight consolidation and then you take out the range. That's just a nice, easy play. It's not the sexiest name, but what you're essentially going to get is like after you get a trend, right? You're going to go sideways for a period of time. You'll build a little flat top on the name. And when you take it out, you're going to get the subsequent moves. I love this type of name. In a particular hot stock, I will do all the patterns sometimes in one day on the same stock, right? Because you're going to have all sorts of opening movement, then you'll have midday movement, then you'll have end of day movement, and you can play all of it. Now, the VWAP, that's the line in the sand. My favorite is VWAP bounces, or if you're looking to fade a stock, then it's going to be, right, VWAP fades. But this is where you'll have like a trending name, right? And then it usually happens around noon. It'll be usually like a more of a lunchtime thing. You'll pull back into the VWAP, and then you get a candle to hold, and you're ready to go. So for us, right, like you get this nice push, you pull back into the VWAP. When you get a green candle to hold, you're into it. So for me, I re-longed this thing. You can see 11:07, that's Central Time. So I re-added HIMS around 45.42. I sold off a portion of it, 46.15 for just a little cheddar, right? I want to get a little money in the pocket. And then after it starts to trend towards the end of the day, I'm just riding it up the EMA. Sold the last 1,000. This is all really one trade right into the close, right? And I did leave a little bit of money on the table as, frankly, I closed it off too early. You know, I was taking my little boy to the beach, and I probably could have really nailed down another dollar or so, which would have been sick, right? So just something to be mindful of here. But you can see, like, so you get the VWAP hold at 45.42. I could have got it maybe even a few pennies lower. I want to always sell some into that first spike, you know, as I cover some of my risk. Then you kind of come back and just retest this. That's okay. Like your stop always goes under the VWAP. And then as it starts to speed up as you come out of lunch, then you want to just kind of trail up your EMAs and do it. Guys, news plays will trend. Let me just say this. News plays will trend. Like this was TEM yesterday. We've been trading this thing nonstop. Similar, right? Like you had the earnings out and then you start the trend. And even today, right? Like just a beautiful trend. We did the VWAP hold on this one too today, right? You get this nice push. You get a pullback right into the VWAP, right? You want to add down when you get a green candle to hold. And dude, it's off to the races like on these things. You get yourself a nice trend. And look, stocks will move a lot more choppy, but see, because you have the earnings, see all the increase in volume here? Because you have the earnings, it's going to move clean for a couple days. And so these are good trades to really think about because it's going to give you a lot cleaner entries. Now look, the risk management is the key, right? Now, people do really weird risk management principles. They're like 1% here, then I do that in my, you know, in my spreadsheet, and I add a 0.2 and this. No. Risk comes down to what's your pattern, right? What's your pattern that you're trading? And then the stop loss goes under that pattern, and you give it a little bit of room, depending on the stock's ATR. And so if you do a VWAP bounce, then the stop loss goes under the VWAP. If you do a flag pattern, for example, right, your stop loss is going to go under the 9 EMA, which will be like your nearest support as you start to break out. So every pattern has its own thing. If you did a 50 EMA bounce, where would the stop loss be? Well, the stop loss would be under there. So, for example, in this particular scenario, as we've been trading this so much, right? On my first entry here, I just put a stop under my EMAs. Then when I reloaded this thing, I put a stop under my EMA. When I reload on the bounce, put a stop under the EMA. When I load back into the VWAP, my stop loss goes under the VWAP. So that's your just basic risk management principles, right? And then what you want to do is size your position accordingly. Very important. You size your position accordingly. So, for example, say you've got a $50,000 account, right? And you want to risk $500 per trade, right? So you get $500 per trade. If you've got a $1 stop loss, you're going to have 500 shares. If you have a 50-cent stop loss, you're going to have 1,000 shares. If you have a 25-cent stop loss, right, you're going to have what? 2,000 shares. And so that's the principle of risk management, right, that you just need to know. Stops go under the pattern, and then you size your position according to that risk. Now, as you get more experience, you can add more size on high probability setups, like things that you know you trade well. For example, if you trade earnings plays well, or you trade pullback trades well, once you know your statistics, then you're going to be able to kind of add a little bit extra oomph onto the trades. Now look, when you're doing the market preparation, right, map everything out from big picture to little picture. So I always go big picture, right? So you're looking and saying like, okay, I want to buy based on the big picture. Then I'm going to an intermediate, mapping out my levels. Then I go to the intraday chart to start to shred it, right? So then I go to the intraday chart to start shredding it and get my precise entries and exits. That's how you want to prepare to all of this, right? Check the news, map out your zones, and then, right, what's your bias? This is really important too. I find that if I'm shorting stocks that I thought were long, or I'm longing stocks that I thought were a short because of just the small fluctuations in price action, I usually screw up the trade, right? Like you're like, man, I really want to long this stock, but then it just goes down a little bit and you're like, you end up shorting it and you're like, ugh. And then it just reverses. It'll hit some imaginary support, some Fibonacci line, something like that you're not watching. And then poof, right? It starts to take off. That's when you get yourself in big trouble. So just be mindful of that. You don't need to even get into any of that stuff. All right, post-market. The money's made in the preparation. The money's made after the market. That's when the real work is. For every minute you spend clicking buttons, you should spend 10 times more, right, time preparing. That could mean reading. It could mean studying, watching videos, watching classes, like things like my boot camp or other people's classes. Get some education somewhere. And then it could be other types of preparation. Do exercise, sauna, reading. I like to walk on the beach. I lift weights, and I like to walk on the beach. I take my little boy. We go and cruise. He loves the beach. But that's like also just a little mental preparation for me, right? Just getting that brain kind of cleared out, really just kind of syncing with myself. I find that like if I don't spend a lot of time outside, it means I'm in here too much and I end up doing stupid stuff. I do like a lot of stupid stuff because you just end up jamming buttons, right? Like all day. You're just like... So getting outside, I think, is something really important, right? Journal your trades. I use TradeZilla. You can, and make sure you're just reviewing and adjusting kind of like what's happening. So I personally, I like to use TraderView. Like you've got like really good stats on this stuff that it'll keep like, really everything you need. Journal entries, all of this kind of stuff. I do tend to scale in and out of stuff a little bit aggressive sometimes. When I'm trading futures, like, you're kind of more scalping. When I'm trading stocks, it's more like I buy, sell. So, one trade is like usually 3 or 4 entries, where in futures, you're kind of like, kind of coming in and out. Same thing with options. You got 20 contracts, you're kind of scaling in and out. But this TradeZilla's got like a nice dashboard. The other thing that I personally myself like about it too is they got a really nice like kind of mentor mode here where I can even see like all my other students and what they're doing too. I got some good students, man. I love grading people's trades and seeing what my people are up to. So, TradeZilla's got a lot of good functionality. You can score your day. You can also put in in TradeZilla, like, personal things like, hey, I want to take 10,000 steps today. I want to read 2 hours, so on and so forth. And that will kind of get you all firmed up. So I think post-market, you want to do a couple things. You got to first start with your journal. From there, start running your scans. And the reason I want you to do the journal before you do the scans is that you're going to have, you may need to trade different types of stocks depending on your journal. For example, if you're journaling, you're like, fuck, man, I'm getting smoked on small caps. Well, then what do you got to do? Like, you got to trade large caps, right? If you are getting smoked on lower volume things, hey, I got to pump up my volume a little bit. So you're going to shift around your scans accordingly. So just be mindful of all that. Post-market is where the money is made. So guys, I love you guys, all right? Let's go in and figure out how to do this a little bit better. If this breakdown helped you and you want to watch me actually trade live, I host live sessions 4 times a week inside my free community that you're going to have access to. I call out setups, walk through entries, and give real guidance, no fluff, all live in our community. Plus, you get instant access to our free $3,000 day trading course. The exact one that we used to sell now is 100% free for you. And if you're serious about going full-time or scaling to consistent profitability, we'll get you some info on our 60-day trading bootcamp, where I work personally with a small group of traders to go from inconsistent to confident in just 60 days. No pressure. The free stuff is an insane value just on its own. Check the link in the description. Join the free group.